Yeah, I didn't think there was a lot to take, to be honest. I definitely felt this was going to be a tricky meeting to forecast, and it was definitely going to be a tricky meeting for markets to digest because so much has happened so quickly, not just in terms of data, but in terms of Fed policy. So it felt like the right thing for me would be for the Fed to stand pat, to not introduce any new measures, to give us their updated projections so that we can see how they are seeing the sort of material future, the medium-term future. And then it's obviously about the communication strategy around that. And that's where in the past, Jerome Powell has had a few issues just in the press conference. I don't think he really did yesterday. I thought it was an okay performance, but essentially what they're telling us is that there's huge damage to the US economy. Now, if that's a surprise to the investment community, then I really have lost, all ability to understand what's going out there in the world, because markets cheering a payrolls report, which was a huge positive surprise, was almost immediately then sort of walked back a little bit by the BLS who produced those statistics. And even if you took them at face value, what you saw was an unemployment rate 3 percentage points higher than the worst of the post-GFC period. So to me, that tells you that there's a heck of a lot of wood to chop. There's a lot of work for the economy to get back to normal. And I think the Fed has just confirmed that. That shouldn't be new information, but I think for a few market participants, it may be a bit of a cold shower after what's been a quite remarkable risk-on period.
And on that point, I mean, you say that it shouldn't come as a surprise, the Fed's economic forecast. It also comes after we've heard forecasts from a number of other authorities around the world, the ECB, the OECD yesterday. Do you think the Fed's forecasts are realistic? And, what is driving this big reaction in markets if it shouldn't come as a surprise?
Well, I mean, to take the latter point first, what's driving this reaction in markets? Unfortunately, again, we've created a financial market which is thoroughly and utterly addicted to Fed stimulus, and it's been getting a heck of a lot of that recently. And so if you keep giving a kid candy, it doesn't take many, many minutes of not having a new lollipop before the kid starts crying. And essentially, I think that's what we're seeing this morning. Are the Fed's forecasts realistic? I have absolutely no idea. Economic forecasting is a very, very tricky thing at the best of times. Trying to make 1, 2, 3 year ahead forecasts in this environment, I think is next to impossible. But to me, the key piece of information, or the key understanding about how the economy is likely to work, is that this sequential growth improvement that we are seeing and likely to see in the near term really doesn't tell us a lot about the medium term trajectory of the economy. And I think where the market has latched onto the idea that really lockdowns, further lockdowns, and adjustments in consumer behavior and corporate behavior because of the virus are the main downside risks to the economy, I would argue that actually they may well be downside risks to the economy, but the more material risk to the medium-term trajectory of the economy is the amount of debt and the need to service that debt. And what we're about to experience is another essentially balance sheet recession period where corporates and consumers are required to manage their balance sheet into the future, and that drags on activity.